So we have a great pleasure to be joined by Vincent Deluard. He's the director of global macro strategy over at StoneX. Vincent, great to have you on the show, bud.
Great to be back. Thank you for having me.
Vincent, it's Kevin here. I see that you changed your name since you've been on the show last. Not you yourself, but your firm. It's no
Yeah,
longer. What was the old name?
the old name was INTL FC Stone, and no one could remember it, so we moved to StoneX, still the same
StoneX.
firm.
It,
I guess the focus is on the execution side and the
I get
technology
it.
platform.
It sounds like a little bit like something that Fred Flintstone would have decided, but don't tell your bosses I said that. Uh, why don't you tell, just before we start and we jump into this, why don't you tell people about your firm and about yourself? Just real high level overview, because you have been on the show before. So we can just kind of tell, give us the Cole's Notes version.
Cool. StoneX is an institutional broker-dealer, global financial service firm. We're listed on the NASDAQ. We basically do everything from commodities to securities, stocks, ETF, fixed income, and cash management services. I'm the director of global macro strategy. I've joined about 5 years ago, and I try to write intelligent and insightful things about the market once a week, which, as you very well know, because you do it actually a lot more often in your newsletter, is quite hard, but also quite rewarding.
No, and I love the stuff. We have so much to jump, to go over. So why don't we just jump right into it? I'm going to start with one of your pieces here where you talk about the great monetary disorder, the new golden age for global macro. I thought this was a fascinating piece where you talked about the fact that in the past, central banks tried to dampen down volatility of foreign exchange. And the way that they did that was through monetary means, meaning changing of interest rates. Now, with interest rates all at zero, this is no longer going to be the case. And we now might see a return of volatility in the FX. If I got that right, and why don't you elaborate on it?
No, you summarized it perfectly. I think we came from an era of relative stability in exchange rate. I pinned that down to the first G20, which was in the midst of the great financial crisis. And this was really, to me, all the global leaders kind of getting together and saying, okay, we got to fix that. And we're going to make sure we coordinate our actions. And sure, there were some hiccups along the way. There was the taper tantrum. There was Abenomics. There were times when US rates were rising too quickly. But in general, I would think this era of globally managed exchange rate has been somewhat successful. There was an end to the currency war. There was a Sintra Pact in 2016. So central bankers in general have been mindful of each other's action and have tried to engineer some sort of stability in exchange rates, which you can see in the fact that if you look at the three major exchange rates, the euro to the dollar, the yen to the dollar, and the Chinese RMB to the dollar, we stayed in 20% band for the past 13 years. So every time something got too hot, there was intervention to cool it down. Um, and the tool to accomplish that has indeed been interest rates. Uh, Central bankers had been willing to tolerate deviation from what they viewed as the optimal interest rate for their own constituencies in order to achieve global stability. For example, I'm sure the Fed would have liked to normalize faster, but after the taper tantrum in 2013, they waited a little bit. I'm sure the Europeans were not too happy about Powell's rate hikes in 2017, but you know what? Eventually, the Bund also rallied 100 basis point, and that ensured some stability to exchange rates. The reason why it's not likely to go forward is an economic theory. Well, not a theory, really. It's a theorem by Mundell, who say that it's called Mundell's trilemma. You can only pick two out of three things. You can either have flexible an exchange rate target, control over your domestic interest rates, or open capital markets. Well, we're likely going to keep open capital markets. So we really have to pick between a target for exchange rate or a domestic policy consideration. And I think with the recovery from COVID, no central banker in the world would be willing to sacrifice economic growth for domestic priority over the notion of some sort of globally coordinated exchange rate mechanism.
So, for those who don't know, I think that the Mundell, I had to look it up because I had never heard about the Mundell, the theorem, and it actually is also known as the impossible trinity.
Correct.
And why don't you just explain to people what the impossible trinity is and how it works and why that's important now?
Yeah. So this is really something that's at the heart of every balance of payment crisis. And it's a hard constraint for pretty much everybody, developed and developing nations alike. And what it says is that if you're going to have an open capital account, meaning if you're going to allow foreign capital to come in and out of your country, you have to pick between either targeting the exchange rate or targeting your own level of interest rate. So if, say, you choose, let's go with the extreme solution like Hong Kong. If you choose to peg your currency, so you have the absolutely clear target for exchange rate, then you have to import the monetary policy of the country you're pegging to, which is why the policy rate in Hong Kong generally follows that of the Federal Reserve.
Right.
So that's one spectrum. On the other spectrum, you can follow the path of, say, Japan or the European Union, where it's like, okay, we're going to let the exchange rate float because we think it's better for our economy, and we're going to accept some volatility there. But what we want is to adjust the interest rate to what we feel is necessary for our economy. So we'll get our interest rates to zero or negative, and then God knows what happened to exchange rate. It's not within our mandate. So that's the theoretical framework. In practice, it's more like a spectrum, and central banks, kind of cheat and move along that spectrum. Sometimes they favor currency stability, or sometimes they favor their own domestic priorities. And what I'm trying to explain is that we moved from an era where there was at least some concern about exchange rate stability to an era where the overriding priority is going to be setting up, stimulating the economy as much as possible with monetary policy. I mean, this is basically MMT, if you want. If we, and I believe it's this where we're going, or we already are, if we argue that monetary policy is subservient to the political authorities, it's subservient to fiscal policy, it's actually integrated within fiscal policy, then that means that the central bank is effectively tied to politicians and has to do what they're being asked instead of trying to kind of run the global show and coordinate their actions over central bankers.
So in essence, the volatility, whereas before it was in the fixed income market, will leak into the foreign exchange market.
Absolutely. Okay. That is the conclusion. And with volatility, you can, it's like pressing on a balloon, right? You can suppress it somewhere; it's going to pop up somewhere else. And when you suppress interest rates, it's going to move to FX. The last time we had something like that was the 70s, where we also had a global financial order that kind of unraveled, and what followed was a decade of extraordinary currency volatility.
Right. And why do you think that will be the golden age of macro? Like, why kind of walk us through your thinking there, why you call it the golden age?
Because big global macro bets like the kind that George Soros or Stan Druckenmiller would make back in the 90s are going to come back, and this is where you're going to make your money. I think on the prior podcast, I think we discussed the death of the 60-40 portfolio, which now has become the consensus, right?
Right.
If you look at most traditional asset classes, are priced to deliver, I would argue, negative real return for the next decade. I mean, this is what the tips market is telling you. Like, if you buy tips today, in 10 years you'll have less money in real terms than you put in there right now. Right. I would argue it's probably the same thing with stocks. So if traditional assets are priced to deliver negative real returns, well, suddenly there's a market, the FX market, that has a zero expected gain. Suddenly that's very exciting. Right? When everything is negative, getting to zero on average is actually quite good. And hopefully, because we're going to see all these global macro disorder, if you get the right currency at the right time, I think you'll be able to have massive gains because this kind of artificial cap on currency volatility that we had for much of the past 20 years is going to be gone.
So, Vincent, I happen to agree with you. The market doesn't seem to agree with us, because I was just pulling up the Deutsche Bank FX Volatility Index, and it's poking along at the lows. It's the lowest it's been since COVID. So maybe that just means that it's all the better time to buy some volatility.
Yes, I mean, let me stress that this is a secular call that I expect to play out over a decade and not necessarily the next 3 months.
Fair enough. I completely get it. And before we kind of go on to the next topic, I'd just like to talk a little back to the impossible trinity. And I just want to highlight that one of the things is that if you think about China, and we go back to the impossible trinity, which is you can't have an open capital movement and also control the foreign exchange rate and your monetary policy. Well, that's one of the reasons that China can't actually open their capital account, is because they want to control both foreign exchange and monetary policy. Do you think that that's going to change in the coming years, or are they just going to continue to kind of try to straddle those and achieve the impossible trinity?
Eventually, they'll have to let go of the capital controls, and I think they want to do that as well. They just don't want to do it in a controlled manner. So it's going to be a process, not a binary outcome. But the overriding goal for the Chinese leadership is to break away from their dependency on the dollar. I mean, this is China's biggest geopolitical weakness, is that it needs about $600 billion to settle its bills in the big four commodities like oil, soybean, iron ore, and I forgot the last one. So the Chinese economy needs access to dollars in order to feed its population or to build its roads, and that is a problem. That's why, especially when the U.S. tells them, "Hey, we don't want to run a current account deficits with you anymore." So the only way to do that is to let the yuan become but at least a reserve currency in its own right. And you cannot do that if you have a closed capital market. You have to let capital move in or out. Otherwise, no one will ever accept yuan to settle trades if you cannot get them out of the country.
Right.
So they're very aware of that. They're progressively working towards that. They watched the Japanese experiment in the 70s and 90s. They're very careful about not moving too fast or not letting an appreciating exchange rate ruin their competitiveness, but that is the end game for them. There's no doubt about it.
Why don't you tell, for people that aren't familiar with it, the story of what Japan did? Because they were faced with a similar situation in the 90s or the 80s, I guess, and how they chose to deal with it sowed the seeds of a huge asset boom and eventually caused this kind of overriding deflation that's continued to this day.
Yeah, correct. I mean, because the Japanese capital account was open when the Japanese economic miracle was happening, and then the Japanese firms were buying hotels around the world, and the Japanese stock market was like almost half of the world equity market cap. Tons of capital piled into Japanese assets and created this massive bubble. And it took them, a generation to recover from that, because they had overvalued asset prices, overvalued real estate prices, and overvalued currency. And that really cost them, 3 decades of growth. So China has been watching this and learning from this and tried very hard to prevent that from happening. And that's one of the reasons for the capital control. And that's also one of the reasons why, up until very recently, they were very reluctant to let the yuan appreciate. But right. I think this is all slowly changing. That's kind of the second part of my argument, is that we will see a emerging currency bloc rise in Asia around the yuan, in the same way that the great monetary disorder of the 70s created the European monetary system, the European monetary snake, and eventually the euro around the Deutschmark.
Okay, so back with the Japan, the Americans forced them to appreciate their currency when
the Plaza Accord,
the Plaza Accord, and then that sowed the seeds for the bubble, and China. That's why they've been reluctant to take the same path because they saw how it worked out for Japan and said, hey, it's not working so well for them. Let's not do it. So why don't you walk us through, though, of what your theory is? And I see, back to your original thing that there's going to be all sorts of alpha created from foreign exchange. I see one of your big calls is that you think that Asian foreign exchange is the place to be in the next, years and maybe decades to come. Why don't you walk us through your thinking there?
Yeah. So there is a cyclical argument that's very simple, and I'm just going to skip over it. But it's basically, okay, Asia has won COVID, right? I mean, they had much fewer infection. They controlled the spread a lot better. They didn't have to close their economy, and as a result, we're in a position today where their economies are growing. Everything's back to normal there. Current account surpluses are actually at record high because there's been a huge demand from for exports from the West because their economies were shut down, so we had to buy everything from Asia. Reserves are very high. So generally, if you just take a simple macro view, Asia is the only real rates are positive, which is an anomaly compared to the rest of the world. So just based on that, I think you have a case to own Asian currencies. The traditional problem with Asian currencies is that they typically have the greatest fundamentals, current account surpluses, reserves, growth, so forth, but they were capped. The Chinese would not let the yuan rise, and as a result, all the other Asian central banks would follow suit. Thailand would effectively, I think it's actually been named a currency manipulator by the U.S. Treasury and across Southeast Asia. And the reason all these smaller central banks would do that is because they compete head to head with China. So if China is going to do an export-driven, cheap currency manufacturing economic model, they all have to do the same thing, right? I mean, if you're, and again, this is the same logic as we had in Europe in the 70s. Like, when you trade, half of your trade is with Germany, you kind of have to follow what Germany does. I mean, it's the same problematic, maybe even stronger because the relative weight of China is even larger than that of Germany and Europe. All these countries, all these smaller Asian countries have to follow the lead of China. And they did that on the downside in the 90s. So 1994, from 1989 to 1995, the Chinese yuan was devalued by close to 70%. On top of that, the Chinese economy was slowly being open. You had the full modernization from Deng Xiaoping. So you actually had soaring productivity, massively undervalued exchange rate. And that, to me, was the start of the great moderation in the West, because suddenly you had basically 1 billion people working for free. And that model spread out through East Asia. Thailand, for example, in 1997 had to devalue the baht because they could not compete with China. And then it was like dominoes, and it was, South Korea, and then eventually Indonesia. And after that, basically every single Asian central bank adopted the Chinese model, repressed the currency, forced the savings, have massive current account surpluses, force the savings into foreign exchange intervention, sterilize everything by buying U.S. treasuries, repress domestic consumption, and then do manufacturing export-led type of growth. And that has been a huge deflationary shock for the rest of the world, right? Suddenly you had basically about half of the world lives in China, Southeast Asia, and Japan. And I would say the most productive half of the world lives there. And this region was suppressing its consumption and subsidizing its production. And they've done that for 30 years now. And I think this model is about to change, and the world's not ready for that.
What are the investment implications of this model? Well, actually, before we go there, why do you think the model is changing?
I'm a big believer that over the long term, demography is destiny, and I would go back to demography. The reason why Asia adopted these policies of export-led growth and demand suppression was because they had a massive youth bulge that needed to find jobs. So if you look at birth rates in China, China especially is a good example because during the Mao years it was the more babies, the better. And then after Deng, suddenly you go to the one-child policy. So it was the birth rate in China were super high all the way up to the late 70s and then collapsed from the 80s to the 90s. So which meant that, a lot of kids were born in China in the 70s, in 60s and 70s. So they all entered the labor force in the 90s, which is why China had to devalue their RMB, because they had to provide jobs for hundreds of millions of workers, and they didn't have the domestic demand to create these jobs. I mean, this was a dirt poor country. This was actually poorer than most countries in Africa. China was poorer than most countries in Africa in the 80s. So the only way, the fastest way to create jobs for a huge youth bulge is to develop an outsized and subsidized manufacturing sector. And you do that by opening trade with the rest of the world, which they did with, joining the WTO in 2000, in the late 90s, and repressing the exchange rate so that your export becomes super competitive, so that you can provide jobs to everybody. That was the driver back then, and this is what's changing, because guess what? All these people who were born in the 1970s, well, now they're turning 50. If you look at the median age in China, I think it's a little over 40 now versus 37 in the US. If you look at the fertility ratio in South Korea is less than 1. I mean, the demographic transition in Asia has happened at an incredible speed, something that we've never seen. I mean, people thought back in the 70s, we're going to run out of everything because we had too many people. Right? That was the Club of Rome guys. And then what these guys could not model is that Asia accomplished its demographic transition, one which had taken more than a century to do in Europe and the US, in 30 years. So now they have the exact opposite problem. They have shrinking labor forces, aging population, and they don't need this massive manufacturing sector anymore, because they don't have young people to give jobs to, right? When you have an aging population like Japan, like Europe, economic growth is not that important anymore, because most people are retired. So you'll see that growth rate is going to start falling. The investment rate is going to start falling. Manufacturing export is going to start falling. Current account will go from surpluses, massive surpluses, to deficits. Basically the exact opposite of what happened in the past 30 years. So I see two implications market-wise. One, the most immediate, is that exchange rates, which have been suppressed for 30 years, are going to have to play catch-up. And they'll play catch-up very rapidly. My template, again, is what happened in Europe in the 1970s with the Deutschmark, the Swiss franc, the Dutch guilder gaining more than 100% versus the US dollar in a decade. So that's the first one, and probably the easiest one to make money with. The second one, and the most unpleasant one, is that just as the policies of demand suppression were deflationary for the West, the new policy of accepting a higher exchange rate is going to be massively inflationary. We will no longer have massively subsidized manufacturing capacity by the half of the world that lives in the Asian continent.
Okay, so let's take those two kind of investment implications one at a time. I'll start with the currencies. How would you express that view with your portfolio? Would you just go buy Chinese, assets, or would you buy a basket? Would you pick? Walk us through your thinking there.
Yeah, I think in China, the case for Chinese government bonds is probably as good as it gets. I'm not smart enough. There's probably some stuff you can do in the corporate sector, but you have all these issues of leverage. You have a government kind of cracking down on real estate developers. So, I mean, if you don't know the sector well enough, I think you're just fine with that these would be the last government bonds I would touch, would be Chinese government bonds. They're the last one who pay a real yield. There is still room for, and you have all four engines working for you. You can get spread compression, you can get lower yields, you're still getting coupons, which obviously you're not getting in the West, and finally you get currency price appreciation. So none of these engines are going to be massive in my view, but all four of them, especially compared to the alternative of buying U.S. Treasuries or even worse German Bund, make it the most attractive sovereign bond in the world, in my opinion. Then the second part would be more for investors that are a little understandably edgy about investing in a country that still has capital control, that has a very opaque financial system, that has a lot of leverage. Maybe the best play is to go outside of China and buy the small countries, because we know that they will follow the policies of the PBOC without the risk, the
Right.
kind of policy risk that you have in China. And the metaphor for me, again, going back to the 70s, so the buying Dutch mark in 1971 would have been a great idea, but even better, buying Swiss franc or Dutch guilder. That had that if you take into account compound interest, that actually worked even better. So the small countries that look like Germany around Germany did better than Germany in 1970s. So if we transfer the analogy, maybe the Netherlands is South Korea, and then maybe Switzerland is Singapore, where you have effectively a play on China without as much policy risk.
Okay, you anticipated my next question there. But going back to China, do you worry about the geopolitical concerns? Do you, like, when you're thinking about investing in a Chinese, sovereign bonds, you're worried that it's going to be a situation where all of a sudden the U.S. government will, or even the Chinese government, there'll be increasing tensions that make your investment a risk?
I think that is a worry, but for every asset, not just Asian assets. It's kind of the Thucydideal trap, right? The rising power. How will the U.S. accommodate the rise of China? There is indeed a risk of conflict. If there is a conflict, I think it's going to be Taiwan. Taiwan is the one big issue. All the other stuff like Hong Kong is settled now. Xinjiang, I don't think I don't think the West really wants to do anything about it. But I mean, if we're talking a nuclear war between China and the U.S.,
doesn't matter in that case.
Yeah, the value of your Chinese government bond holding is going to be the least of your worries.
Yeah, that's right. Okay, so the second part of your kind of thesis is that we're going to get increased inflation. Why don't you walk us through the investment implications of that increase in inflations that we're about to experience?
Right. So I'm really happy because and so have you. So has Kevin. That it's been a tough time for inflationistas.
That's right. We were getting hammered pretty bad there in the before this kind of new fiscal stimulus kind of took off. We were definitely the butt of a lot of jokes.
Yes, and now it's kind of nice to see that the reflation trade has become the new consensus. We are seeing this commodity this inflation playing out across. You look at the price of lumber, the price of wheat, the price of copper, aluminum, iron ore. I mean, you name it. Most commodities are up 100% year over year. You see the inflation expectations breaking out about 2.5% in the U.S. You start to see it in the CPI too. I mean, we're at 2.6 last month, and I think it would have been a lot higher if there hadn't been a one-time negative contribution from rents, which I think will normalize and could add up to 1% of inflation by the end of the year. So I'm still in that reflation camp. I think all the news flow that we're seeing in terms of stimulus, in terms of raising the minimum wage, UBI, all these things are lining up perfectly to create a decade of secular inflation. Investment implication, well, I think we're in the middle of the first stage, which is stocks. Usually stocks outperform in the as you get reflation, right? When it's not too hot, the Goldilocks moment where we are right now, where finally we're seeing some inflation and the market is welcoming it. Oh, we're out of this, and it's very hard to disentangle what is inflation versus what is real growth, right? So right now, we're just going to post amazing numbers for GDP, and we'll be happy with that. But then as inflation accelerates, and I expect that to happen fairly quickly by the end of the year, you really want to transition away from even equities really into real assets. I mean, obviously gold, which has been a perennial disappointment for me and many others. Commodities, maybe real estate. And then you need to start looking at pure inflation plays, which for me are in Latin America. This is a region that is short dollar, long commodities structurally, and where you can still buy dirt cheap assets, including the currencies.
And how would you? Is that just going and buying their equity market, or even just their currency? What would that look like?
Yeah, I would say both. Local. I mean, if you look at if you look at the relation between, say, you look at the chart, the Chilean peso versus the price of copper. I mean, usually very high correlation, around like 70-80%, because Chile is the world's largest exporter of copper. And then since COVID, you have this massive divergence where copper prices are at an all-time high, and then the Chilean peso is still about 20% below where it was in 2018. Even more spectacular has been the divergence between the performance of Brazilian real and the price of the commodities that Brazil exports, which are mostly oil, iron ore, soybean, and cattle. If you just run a basic regression model on the price of commodities versus the price of most Latin American currencies, you'd find that they are undervalued by 50 to 60%. So any sort of, local currency denominated asset, I expect will perform well once things normalize.
And Vincent, do you think that's just a function of the nervousness regarding the COVID, the fact that Brazil's struggling with, one of the worst COVID outbreaks out of all the countries, and is that the only reason, or is there something else going on?
Yeah, that is a huge one, obviously, and then politics. People are worried about Lula coming back, and preparing for Lula Bolsonaro type of scenario, which none of these options are very palatable for investors. But I would stress that people tend to over emphasize politics because it's sexy, right? It's like, oh, this guy's a socialist, or this guy is a populist, and it makes for like good headlines. But as far as policies matter, Bolsonaro was supposed to be this great guy who was gonna reform the pension system, and then everybody loved this finance minister, and you know what, he turned out to be quite disappointing, at least for the perspective of the people who liked his economic policies. On the other side, AMLO in Mexico, he was the devil incarnate, right? He was like the Marxists are taking over the country. And I'm not saying that AMLO has been a terrific economic manager, but by the standards of Mexican governments, he hasn't been all that worse than the other guys. Actually, Mexico, for that matter, has, I would say, run its economy very conservatively, especially on the fiscal side. So the big, debt crisis that people expected after the election of AMLO has not occurred.
Don't talk too much about Mexico, because we're going to get there, and I want to ask you about your latest report. But before we get there, gold. Do you have any theories as to why it's been such a disappointment?
The only two things. One is real yields. As we've seen this big backup in yields, obviously gold is typically negatively correlated to yields. Now we're seeing yields give some of that back, so I think that's a nice setup for gold, especially as, if I'm correct, we'll see inflation accelerate, so that people will realize that the increase in yield that we went through was just an increase in inflation. Real yields have actually stayed flat, if not went down, but for now it feels, yields are going up, so I need to sell gold. And then the second one is obviously Bitcoin. It's the millennials gold. I think it's diverted flow from gold into crypto. And again, I'm going to look like a total idiot, I'm sure, by saying this, but maybe the Coinbase IPO was the top. The way the Blackstone IPO was the top of the 2007 cycle. Maybe it is like we're seeing some sort of regulatory crackdown on Bitcoin. So if we see the crypto bubble deflate, I think some of that money goes back into gold.
I don't know if it's going to be the Coinbase or the Coin IPO or the Dogecoin weekend. The Dogecoin. I don't know if I can say that right. I'm not supposed to talk about it though, so I got to go on to the next subject. Why don't we bring up here? I love the title of your latest piece. It's called "Surfing the Blob in Europe and Mexico and Hedging with Anti-Fragile Assets." What's your thesis there? Tell us about it.
Well, let me start maybe with the blob, which you're based on the west coast of Canada, so you're.
Well, no, we're actually East Coast.
Oh, you're Toronto.
Yeah,
okay,
we're Toronto.
Well.
We're not Vancouver. No. I wish we were.
I'm sorry for you, man. So the blob was a body of warm water that was kind of floating around in the Northwest Pacific a couple of years back, and it just wouldn't cool down, and it brought a bunch of climate disorder, right? It rained in Los Angeles, which people don't know what that is. Seattle had some sun, really weird
both
stuff.
both cities were extremely confused by that weather.
Yes, and there were a couple of bad winters in BC, I think, snow-wise, and all these was because the Pacific Ocean was abnormally hot and wouldn't cool down. And I use that as a metaphor for we have this blob of liquidity, and I think you have like two drivers for it. One is the one I briefly hinted at, which is these Asian surpluses. It's been going on for a long time, right? As we repress the value of Asian currencies, you have all these extra savings that are kind of like floating around, going from one asset to the next. That was the original blob. And then on top of that, you have a much larger blob, which is the central bank blob, where, central banks have been printing these. I think where are we at 10 trillion? I think if you look at the G10 central banks, I think we're at close to 10 trillion in central bank balance sheet expansion at this point, and it's not really making its way into the real economy, right? That's the challenge, and that's one of the reasons why inflation has been so slow to pick up. Is despite all this money creation, it's kind of stuck in the financial system, and what it does is that it goes from one asset class to the next. And it's not the normal pattern of bubbles where you get a bubble and then it corrects and then you have capitulation. No, the blob moves, goes away, and picks something else, but things never really correct. So you saw the blob in electric vehicles, you saw the blob in crypto, you saw it in big tech before, reopen stocks at one point, and it just keeps rotating. And it seems with increasingly rapid pace, like almost a frantic, what is the next big thing? Like, well, what should I buy? So I don't really have a view on what will happen to the places that received the blob in the past. Like maybe crypto keeps going. I don't know. But I think what investors should focus on is, okay, where is it going to move next? And I would single three areas for that. One is Latin America and Mexico especially. I know we'll talk about this later. Two is Europe value and reopening plays in Europe. And then three is precious metals.
Okay. Which one would you like to hit first? We already talked about Latin America, so why don't we get into Mexico? Why don't you tell us why you think it might be the kind of recipient of the next blob of liquidity?
Right. So I think 2021, you have three major stories that will dominate the investment narrative. One is the U.S. consumer, right? We have a U.S. consumer that's turbocharged on steroids. People are generally, savings balances are up after COVID. Credit card debt payments are down. Job market has come back roaring. The real estate market is on fire. And then on top of that, you add, $2 trillion stimulus on an economy that's already overheating. I mean, we'll see amazing numbers from the U.S. consumer, especially as we get the vaccine rollout and all of that. So that's one story. Second story is steeper yield curves. So we're still anchoring the short end at zero, but we are finally allowing long rates to rise a little bit. And then the third story is reflation and a rally across the commodity complex. Well, Mexico is at the core of all three, right? I mean, the U.S. consumer is going to do well. That's going to be good for Mexico. And Mexican exports to GDP is about Mexican exports to the U.S. about 50% of GDP. So Mexico probably has the most leverage of the U.S. consumer of any economy in the world. Also, there's just the remittance channel, right? You have a lot of Mexican workers in the US that send money month after month back to Mexico. This is already up 20%. And these are people who will benefit from the stimulus checks. So you'll see an upsurge in remittances, which will help the domestic economy and also the exchange rate because people need to sell dollar and buy peso. So huge play on the consumer. Next, the yield curve. Mexico is a very, very much like a typical emerging market index in the sense that the largest holdings are, energy and banks, right? So when yield curves are steeper, banks do better, and mechanically, because of the weight of the index, that will help the Mexican index. And then the last play is reflation and commodities. So Mexico is obviously the energy sector is deeply troubled in Mexico, but there's this windfall, right? I mean, it's like an accident that's not going to happen. Everyone expected Pemex to go bust or to create some sort of a budget problem. Well, with oil prices at in the 60s, that we can postpone that. So that's something that we don't have to worry about anymore. And then you have all the other stuff that Mexico exports, things like silver, precious metals, even agricultural commodities that are all benefiting from this rapid reflation. So Mexico is, to me, at the intersection of the three major themes of 2021, and it gets in there with a very cheap currency and its first current account surplus in 30 years.
Oh. I'll throw in another, I think, secular tailwind to Mexico in that before China joined the WTO, Mexico was going to be the cheap labor for the American economy. And then when China came along, it stole a lot of that manufacturing from Mexico. I'm wondering if with the increased tensions between China and the U.S., that maybe Mexico will come back as the backyard, manufacturer for America.
Correct, and that is especially the case. So there's the trade tensions. By the way, the tariffs are still on. I mean, Biden has not removed the tariffs on China, and it's not clear that he will ever. So I don't expect to see much of a change in this trade dispute between China and the U.S., which benefits Mexico. But beyond that, there's the argument that I was making earlier about in the next decade, Asia no longer subsidizing its manufacturing sector because the demography has changed, and that means that the competition for kind of low end to middle end manufacturing is certainly going to be a lot more favorable to Mexico. If you look at the graph of labor costs between China and Mexico, I mean, Mexico has been flat for 10 years. In China, it's been rising at 10%. And now it's actually more expensive. I mean, depending on which sector you're looking at, but if you take into account transportation cost, it's probably more expensive to produce in China than it is Mexico. And it will keep being that way, especially if, as I expect, we see a massive revaluation of Asian currencies.
So that's great stuff. Can you just buy Mexico across the board? Stock, bonds, currency, like the whole 9 yards? You think they're headed higher?
I would think so. I mean, this is a story that will impact every asset class. And again, generally Mexican assets are fairly cheap. I mean, equities have rallied, but in my view, they still have some way to go. If you look at fixed income assets, you're still getting quite a high yield, so you can play it across the spectrum.
Okay, the next part of your piece here, and this is something that I've been thinking about for a while. You conclude that Europe has reached peak COVID despair. I'm extremely interested because I've been worried that the market will start to see through it. Even though I think that COVID might get worse in Europe, the market will start looking through it. And I take it that you came to the same conclusion.
Yes, so I actually just came back from France. I was there for 2 weeks. It was an odd time to be in France. The plane was empty. Technically, I could not have left a 10-kilometer range around my house. I needed to have some sort of a piece of paper. Everything was closed. And Paris without the cafes and the restaurants and the museums and the art. I mean, it's just like a messy, ugly version of any American city at this point. Okay. So obviously the mood was very, very grim. It's been and again in the U.S. Maybe Canada is a little in the middle, but Americans don't understand how hard the lockdowns have been in Europe. They complain about, I don't want to wear the mask. Well, how about being stuck in your house for months, with everything locked down? And that basically, stop and go, right? I mean, okay, lockdown, then we open, then we lock. This is like lockdown number 3 in Europe. I mean, people are just they've had it. So this is why I was referring to peak COVID despair. At the same time, things are going to get better. Yes, Europeans have messed up the vaccine rollouts. France, especially. I think Canada did the same thing. We went for the slow rollout. Yeah. Whatever. But eventually, we the government kind of corrected its mistake, and you can see that basically the European vaccination program is tracking the U.S. with about a 1-month lag. So the new death, the hospitalization, the new infection, all that starting to plummet in the U.S. about 1 to 2 months ago. So this is going to hit in Europe. We also just the weather, like the same way that last year infections, it was really bad in March, April, and then we had a normal summer in Europe because people got out again, and then finally, of course, these political considerations. I mean, let's never forget that COVID is very sensitive to election polls. Uh, France is going to get into an election next year. Italy and Spain is going to be the next year or the one after. And I mean, holidays are vacation. Holidays are religion in Europe. Like there's an economic weight about 10 to 15% of GDP is linked to tourism, and then there's you cannot take away the month of August for you'll get a revolution in the street, and politicians are smart enough. So I think one of the reasons why we had these very stringent lockdowns in Europe in the spring was that so that we could get the numbers to look a little bit better by the end of May, and then be like, okay, great, we reopen and save the tourism season for the summer.
Okay. Now, so given that, what you think that the worst is in the market?
I was looking at some of the reopening plays. I mean, again, it's not like, to be entirely honest, I prefer the Mexican idea. But obviously, no portfolio manager is going to go 100% long, 100% portfolio in Mexican
So
assets.
this is just a tactical, observation that you think that the worst is in the price already.
Yes, and if you look, I mean, generally there's a strong correlation between the performance of sectors in Europe and in the US, but there's a gap that opened. I mean, first of all, in general, the US premium or the European discount is at record high and has been there for a long time. So generally, if you care about valuation, Europe is probably the better place to be. And then, especially if you look at reopening plays, things like hotels, airlines, restaurants, I would say the US has rallied an extra 30 to 40% compared to the similar European plays. And, if we're just talking about a difference in months, which I think is correct, like, Europe is going to be like the US with a 2-month lag, it does not justify a 40 percentage point difference in the price. So,
interesting. At the end of this piece, I'm going to bring it back to Asia just quickly because there was a little sentence here that I loved. And he says, as I explained in the 2 portfolio adjustments for the post-COVID world, Japanese assets are a great way to diversify U.S. and tech-heavy global equity portfolios. I think that a lot of investors are always looking for ideas that, to diversify away from, as their U.S. stocks have done so well and it's become a larger and larger portion of their portfolio, they're always looking for something to diversify into. You think Japan might be that?
Yeah, it has been that for a long time, actually. Just people don't care about it. But, if you look at a chart of the Topix or the Nikkei, I mean, basically nonstop bull market since Abenomics since 2012. And then, breaking major, major resistance level. I mean, 40 years. When you see a market finally break a 40-year bear market, that probably means something. So yeah, it has been, and what I like about Japan is it kind of dances to its own tune. The main driver, there's a supply and demand argument in my mind in favor of Japan. In the US, we're seeing very negative trends here. We're seeing massive issuance of stock, whether it's a SPAC or the IPO boom or stock-based compensation or insider selling. I mean, you're seeing a lot of stock being sold and corporations not buying anything, like buybacks have not recovered very much, for example. So you see more shares being sold. In Japan, it's the exact opposite, right? Because basically the IPO market has been dead for 20 years. No one's gonna be, I'm gonna go list in Tokyo or something, So you have buybacks. Actually, most Japanese firms, there's been a corporate governance reform movement that has led to most big Japanese corporations do buybacks that are comparable to the US, but you don't have any issuance, and then you have a structural buyer. I mean, every month the Bank of Japan goes and presses a button and buys a Nikkei and Topix linked ETF, to the point now where I think they own close to 10% of the stock market. You also have the central bank buying effectively half of the sovereign bond market. So it's not that crazy to think that in 10 years we'll run out of Japanese assets.
Well, there you go. For people that are interested in diversifying out of the U.S., there's an idea. So the last topic for today, and I groaned a little when we were talking about it, was ESG. And I don't know about you, I find ESG, my eyes roll over whenever I see it on TV and stuff. But you promised me when we were chatting earlier today, you promised me it was going to be the first fun discussion of ESG that's ever been been on financial news. So why don't we jump into it? What is your theory on ESG, and what is your kind of unique take on it?
Well, in general, I think the movement has good intentions, and I respect the people who are in it. But I mean, it's gotten to a point where it's ridiculous. Like you've seen the launch of I forgot the ticker now, the BlackRock Carbon Transition Readiness ETF. I think it was the most popular ETF launch. Got like close to like 1.5 billion on launch, and you look at the holdings. What is it? Apple, Microsoft.
I know
Facebook,
doesn't it barely looks different than the S&P 500.
It's the exact same. Like,
Yeah.
well, no. There's an important difference: the management fee.
That's right. they don't charge you the 7 basis points or whatever the ETF is, or 2 basis points that they charge you for the SPY. They charge you 50 or something. What is the numbers? Do you know them?
I think it's around 15. I'd have to check.
It's still
but
low,
it's significant. Yeah, it's still low, but significantly more expensive because now you get basically zero basis point management fee on index funds. But so I don't want to talk about this gimmicky stuff because we all know it's a joke. I think there's 3 issues that I highlight that the ESG movement needs to wake up to: jobs, taxes, and competition. And these have been 3 blind spots that have been completely forgotten. So on the job side, I ran a basic analysis. I aggregated the holdings of the 20 largest ESG ETFs, and then I looked at the 15 most overweight versus the 15 most underweight stocks. And what I found is that the 15 most overweight employed only 1.5 million people, while the most underweight employed 6 million people. And that is, by the way, that's a feature that's not a bug. It's because ESG structurally over allocates to big monopolies in tech and pharma. So places that have a very high market value, but actually very few employees. And you can think of it, right? I mean, how is like the environmental impact of Microsoft? Like, what's the cost of servers? Like, obviously, by structure, the way ESG rating work is going to reward companies with almost no physical footprint and as few employees as possible. Because if you don't have employees, well, you don't have sexual harassment, you don't have discrimination, you don't have lawsuits, and so forth. So there is this bias in favor of like high value added, high intangible assets monopolies. So that's the first issue. Not just focusing on the quality of jobs, but on the quantity of jobs. How do we make sure that capital is directed to companies that will actually provide jobs instead of automate things or rely on algos and robots? Second issue is taxation. So I ran the same analysis and I found that the higher your ESG rating, there's almost a perfect inverse correlation between ESG rating and effective tax rate. Even though on average, companies with a high ESG rating tend to be more profitable. Like there's a quality bias to ESG. Like they generally identify companies that have higher margins, more resilient balance sheets and so forth, but they also pay little taxes. Again, it's the same issues because you go into these big tech monopolies or financial networks like Visa or MasterCard or big pharma, where the biggest asset is IP, right? And IP is very hard to tax, right? Because you can, you set up your IP in a low tax jurisdiction like Ireland or the Cayman Island, and then you can escape taxation altogether. So again, I think there's a huge contradiction between the message of ESG, or like, oh, we want, all stakeholders, we want, capitalism to be ethical again, and the fact that effectively it just allocates money to monopolies that cheat taxes. And then the last question was kind of embedded in the first 2 is competition, which I view as one of the biggest socio-political issues of our time, is the concentration of the US economy around a handful of monopolies that have acquired an insane amount of not just economic, but also political power, and the death of competition. And as ESG effectively rewards companies with very large moats, like things like Microsoft, things like Apple, things like Visa and MasterCard, we're actually making the problem worse, not better.
Vincent, I see on your piece here, you talked about the 2 most eye-opening books I've read on about the U.S. economy in the past decade were I don't know how to say this guy's last name, T. Philippons, I guess, The Great Reversal, How America Gave Up on Free Markets, and D. Hearn and J. Tepper's The Myth of Capitalism, Monopolies and the Death of Competition. Are they that good? Do I have to go buy those books?
I recommend it. They're excellent. And again, this is something that I think has flown below the radar in the political debate. But we have ultimately, I think I blame it on antitrust enforcement. In the early '80s, there was this concept called the Consumer Welfare Standard, whereby, under the old logic, Sherman Act and so forth, just being a monopoly was enough to warrant an investigation. So you had very active monopoly enforcement. And then starting in the early '80s, regulators said, no, you need to show that the monopoly is hurting consumers. And that's a lot harder to do, especially if you have a big tech company where, the product is free, quote unquote free. It's never free, but, at least it looked free. So we had this massive, since that standard was put in place in the early '80s, complete collapse in antitrust enforcement, and at the same time, massive concentration. And people think about big tech, and clearly it's a huge one, but it's not just that. It's airlines, it's cable companies, it's telecommunication, it's banks. I mean, every sector of the U.S. economy, and I would argue even its politics via political donations and lobbying, has effectively become causalized in the past 30 years.
Okay, so in terms of the ESG, you've sketched out the reasons what you think is wrong with it. Are there any investment implications, or is it just a matter of maybe this isn't as good as we all thought?
I keep going back to my inflation idea, and maybe it's an obsession.
You and me both.
Is.
You and me both, Vincent. You and me both.
So I think there is an inflation angle to what we talked about. One is ESG is a real force and it's here to stay, and it's starting to change the way people allocate capital. I mean, the traditional fossil fuel sector has become uninvestable for a lot of investors, and to me, that means that the response function of E&P and energy companies to oil prices has become a lot slower. For example, if you look at the rig count in the US versus the price of oil, up until this year, usually it was a 3-month lag, right? As if oil prices rebounded, 3 months later, you'd see new oil rigs being completed. This doesn't happen this time. And I think in some ways it's because, no one wants to touch the sector. So I think, and same thing, like if we want to do this ESG revolution, this Green New Deal, I mean, the amount of investment that's going to be required is massive. I mean, you talk about like changing the grid, you talk about re-engineering buildings all over the country. So maybe over time it will be deflationary, but at least the first stage of this transition is going to be massively inflationary. And then the second angle, which again, I go back to my inflation obsession, is the concentration of the US economy around big monopolies I think is very inflationary. I mean, what is the point of building a moat around your business if not to raise prices later? So to me, we have a lot of like trapped inflation in the concentration of US industries in these big monopolies. If Netflix doubled its price tomorrow, they could very easily. If Google wanted, they have a monopoly on AdWords. So you have all these trapped, it's almost like trapped kinetic energy, if you want, that's sitting in there. People haven't noticed it because the big tech firms did not need to raise prices because they were already making money anyway, and it was so easy to raise capital. But if I expect the environment change, which is we are starting to see rising wages, we are starting to see a rising velocity of money, then these are companies that have a lot of pricing power that they haven't exercised yet, but they will exercise it.
I like it. That's a unique take on it. Great stuff. Okay, we're at the end of the interview, but before we let you go, I'm going to ask you, we always ask the guests a few questions, so and I didn't warn you, so I'll just throw them out there, and hopefully you can adapt and think on the fly. You do such a good job of it anyways. So first of all, your favorite investing book?
I would have to go with The Prize by Daniel Yergin, which is about an 800-page history of the oil market. And you're just looking through the lens of the oil market. You see geopolitics, you see economy, I mean, it's amazing how oil has been at the center of really human life for the past 150 years. And obviously this is, someone who's followed the market for, all his life, and extraordinarily insightful.
That's awesome. That's a great pick. Very unusual. Okay, my next one question for you is: I'm going to put in traders / portfolio managers, whatever, or investors. Are they made or born?
That's a very existentialist question here.
Well, you're French. You should be used to these kind of things.
I'm gonna go with Simone de Beauvoir, Simone de Beauvoir. On ne naît pas femme, on le devient. We are not born as women; we become one. So I don't know. I like to believe in human agency and the possibility of people to forge their own path and learn from their mistakes. So I'm gonna say they are trained, not born that way.
I like it. Okay, now the last question here. It's a tough one. You're in San Francisco, am I right? Correct. Okay, so you have to give me. And you did you still live in Paris? Is that where you're from?
A small village in Burgundy, but I studied in Paris.
Okay, so you have to give me something that San Francisco does better than Paris, and then something that you miss terribly when you're living in San Francisco from Paris.
Something that I miss terribly. It's gonna be cheese. Stinky cheese.
I thought it was going to be smoking cigarettes everywhere, but okay. Stinky cheese. Okay, and what does San Francisco do better than Paris? And you can't say the stinky sidewalks from all the excrement.
Something.
There's got to be something that's just like, wow, this is awesome. You're not doing very well. You're going to get kicked out of San Francisco at this rate, Vincent.
I like the geographical setting of San Francisco, the proximity of the sea, the mountain biking. Generally, nature, I think, has been more generous to San Francisco than it has to Paris. But I would say Paris has compensated with, culture and what humans have made of it.
I got it. You have to go. Have you gone to Muir Woods? That's it's not named after me. That's not me, but but it's wonderful in the redwoods, and it is beautiful, the nature and all the beautiful things about San Francisco. Okay, Vincent, why don't you tell people where they can find more about you and your firm, and give us the whole spiel?
Cool. So the firm is StoneX. If you want to subscribe to my work, I guess the easiest is to go on Twitter. My handle is Vincent Deluard. I have a link to a trial page where you can sign up for a 1-month trial. It's free. I write 4 times a week, usually about 8 to 10 pages. And then as far as the firm goes, we trade everything. We are the largest firm you never heard from. We focus mostly on kind of middle market, which are not serviced right and quite often ripped off by big banks, and I think we give them a better deal.
Okay, Vince, I'm going to help everyone out though, because you went really fast with your French accent, and we're not all growing up in the 2 languages. Your Twitter, go real slow for our Americans that might have had a little trouble with Deluard. Spell it all out, or I'll do it. Vincent is Vincent, and the last name is Deluard on Twitter. Vincent, it's been a real pleasure having you on. I really appreciate it. We look forward to hearing from you next year. Thanks again for coming.
My pleasure. Thank you very much.